Hey, what's up, everyone? Here in this channel, you'll find everything you need to know about investing, real estate, stocks, and crypto, and how to get started investing from A to Z. So, in this video today, I will be showing you the 2022 best growth stocks to buy right now. If you're into that sort of content, please subscribe and hit the like button and the bell notification so you don't miss a video. In 2022, growth stocks will be hit once more, this time with shares of competitive companies. Over the previous years, companies like Shopify have dropped 35% while Zoom has dropped 60%. These are world-changing firms, and everyone has the potential to 10 times their money. But the agony is anticipated to last the rest of the year, so you'll need to know where to look for the biggest stocks. I'll share with you the great stocks to buy right now, one of which has a 75% return merely to the average analyst target. Amazon investors lost 94% of their money following the bursting of the internet bubble to $6.70 a share. Those shares are now valued more than 500 times that amount, an annual return of 36% for the past 2 decades. Some of these growth stocks are just as revolutionary, allowing you to achieve the same results in the next 20 years. With interest rates projected to rise, you'll need a method for identifying the best growth stocks to buy, as the returns will be totally different. Furthermore, for David Kostin, Chief Equity Strategist at Goldman Sachs, calls the difference the single greatest mispricing in US stocks. Now, every time I hear the word mispricing, I actually hear it as an opportunity. And I believe this is the most important piece of advice for identifying the growth stocks to buy in 2022. Now, Kostin defines mispricing as the difference between companies with high expected revenue, but those with low or negative margins versus companies with positive margins. And there's some investing jargon in there that we'll have to unpack. But I'll show you exactly what to look for in finding these growth stocks before we get into the list of stocks to buy. Growth stocks are just companies growing their sales or their total revenue by double digits each year, usually at least 20 or 30% sales growth year over year. Margins are a measure of profitability. The net margin is defined as a company's net income divided by its sales. How much of the company's revenue is turned into profit by management? So the difference between historical mispricing and the key to finding growth stocks to buy will be looking for the companies that are only growing their sales at that rate, but are also profitable. The growth stocks already making investors money versus the ones that are still trading on a hope and a dream. So let's talk about the list of the best growth stocks to buy. I'm going to start with a stock that's already changing e-commerce by taking market share from Amazon, Shopify Inc. ticker SHOP. I was actually doubtful that Shopify could even compete against Amazon, but it's formed a brand for itself and a niche in helping people launch their businesses through the site. And the results have been incredible, with 56 revenue throughout the last 3 years and 44 in the trailing 12 months. That's still just 1% the size of Amazon in revenue, so years of growth left, and the margin numbers here are just incredible. Not only has the company been profitable since last year, but it rises its net margin to 81%, which is basically unheard of that level of profitability. The sales are expected to increase another 32% this year to $6.1 billion, and while earnings growth are expected to slow, it's still forecast to grow by 18% annually over the next 2 years. It'll stick with the growth stock idea. Among the 22 analysts here, we have an average price goal of just over $1,600 a share, which would be a $42 greater from here. But like all of these growth stocks, I believe that the long-term return over the years will be between 5 and 10 times that. You don't generally think of Advanced Micro Devices ticker AMD as a growth stock, but it has been putting up the numbers recently. The CPU semiconductor maker saw revenue jump on laptop sales during the pandemic. And while those are looking to cool over the next year, its data center business is still making strong growth, and this new line of Ryzen chips keeps to take market share from Intel. Sales growth accelerated into the last year at a 52% rate from what was already a pretty fast pace before, and the net margin increased to 26.7% in the trailing 12 months. And with the backlog and semiconductors, AMD could still book solid sales growth for years to come. The truth is, analysts believe the company to post by 19% sales this year. I think it will be closer to 20 or 21%, and earnings to increase by 26.5% to $3.34 per share. Now that earnings are growing at a higher rate, experts predict AMD to maintain its net margin profitability throughout the year. Although the average analyst prediction is only up to 4% from here, this is one of the most affordable stocks on our growth stock list. Shares trade for just 11 times on that price-to-sales basis, half the average multiple of the 5 stocks were all highlighted, and I think this one could go much higher than that average target. So don't be dependent on any old Yahoo on YouTube for your investments. Zoom Video Communications, ticker ZM, did not originate video conferencing, but it has gained the lead in that area and has been the norm. In fact, we're already seeing Zoom do for video conferencing what Xerox did for printing back decades ago. Xerox built such a brand for itself that he didn't say anymore, make me a copy. He'd say, make me a Xerox of this. The same thing is happening with Zoom, and I think that service becomes universal for over the next decade. We've noticed that business travel isn't returning to pre-pandemic levels. And while Zoom only generated $3.9 billion in sales last year, I believe that everyone is underestimating how big this can get. This reminds me of Facebook before it figured out how to make income. I recall the failed Facebook IPO in 2012, when the stock dropped from $38 a share to $18 in only a few months because the platform couldn't figure out how to make income out of all those free users. But since then, the stock has risen 18 times return the last decade. Zoom is a lot like that, with a large majority of its users on the free plan. As soon as the company figures out how to monetize this, we could see revenue jump even higher than the 47% it posted last year. Sales growth is expected to slow to 17% over the next year, but I believe that forecast is based on current strategies. And I believe you'll see a number much higher than this. Though the analysts expect earnings to fall over the next year despite the sales growth to $4.6 billion, but given how easily Zoom has beaten earning expectations in the past by an order to 20 or 30%. And regardless of that weak earnings picture expected, analysts still have 62% upside just to average price target. And the shares are relatively cheap here at 14 times on that price-to-sales basis. The stock has sold off quite a bit from last year, and this is one of my favorite long-term growth picks. Right now, Coinbase is still booking most of its money on those fees from crypto users. But the real growth here is going to come from expanding out from crypto into NFTs and other digital assets. We don't have much financials here because the company just issued shares and hasn't been around that long. But 364 sales over the last year is outstanding. This is likely to moderate in the first half of the year because crypto hasn't been doing as well. Just like Zoom, we could see that growth ramp up again as the company expands into these other assets. Besides that strong sales growth, Coinbase is just now coming into its profitability and already booking a 42 net margin, making this one a cash machine. Sales are expected flat this year and 11% higher next. But I don't think Wall Street really knows how to analyze this one. And this sales growth is all dependent on enthusiasm for crypto. So there's really no way of modeling that. But when we start to see the company expand into more of those reliable and consistent services, you're going to see that forecast move up. Likewise, with the earnings forecast, the street just really doesn't know how to model profits when the environment for crypto is so uncertain. So I wouldn't put up so much faith in these figures. What's incredibly interesting about this is that despite of all unpredictability and weakness in sales profits, Coinbase is still rated as a strong buy by analysts with a price target of $400, which is more than 75% higher than the current price. The range is much wider here, with low estimates as low as $160 and high estimates as high as $600 a share. You don't want to narrow this down too much because you don't want to miss out on any great stocks that fall right under your criteria. Our list current focus is on growth stocks with positive margins or those that are already profitable. But we can go even further by looking for companies that are improving their profit margin. Looking for those stocks with increasing profit margins over the last year compared to the previous year. Now, let me explain why this is such a good sign of a great company. It's difficult enough to increase sales by 20 or 30% a year. That usually takes an immense amount of marketing and other expenses. So most companies growing at that rate aren't profitable or certainly aren't getting more profitable. But if you can find a company growing at that rate while also cutting expenses, that's not only a growth stock, but also one with great management. Nvidia is a stock that continues to astound investors with its rapid growth, while other semiconductor companies such as AMD and Intel will be affected by the weakening CPU market. Nvidia has transformed itself into a next-generation chip company with a decade of growth ahead in everything from the Internet of Things to artificial intelligence and self-driving cars. And the company's growth is incredible for a company that's been around since 1993. Sales have increased by 45% in the last year and by 27% annually over the last 3 years. And with that long in, you'd think it's reached its limit in terms of profitability, but it keeps improving its margins, which have risen from 26% last year to over 33% in the last year. Over the next year, revenue is expected to increase by 26% to over $30 billion and then continue to rise. Even more impressive is the forecast for earnings of $9.50 per share by 2025, which is more than double the profits expected this year. Their shares have already risen dramatically, with analysts expecting it to rise another 28% to the average target price. But if this one gets anywhere near that $9 per share profit estimate over the next few years, it will continue to rise. So there are plenty more tips and tricks that we will cover in our channel, but we hope you enjoyed this video. And if you did, be sure to like and subscribe. Thank you for watching, and we'll see you in the next one.